Right. Well, good morning, folks. Good morning. This is George, and it's good to be back. Good to be back after a month. And here we are, well into 2011 right now. And I have to say, what a month January has been. We have had some tremendous trades that we've been able to sort of put on. One or two, of course, that we've missed, and probably missed. Probably one or two too many. You know what it's like, the festivities, and you're sort of overdoing things and what have you, and one might sort of get up a little bit late one morning and having missed some really, really good trades. But we've had trades which have been excellent breakfast trades, excellent morning trades, which is one of the areas that I specialize in pretty well every day. And but we've equally had some very, very good swing trades which have just sort of gone on for several days. And of course, the euro is a real case in point. And well, it's good to see you all here. Good to see you all here. We had an excellent session yesterday. In fact, I can see we've got Pat in who was with me yesterday, and one or two other guys, where we were looking at markets and looking at sort of we were actually looking at harmonics yesterday. We're not going to be doing harmonics today, of course. But let's just have a quick look at the euro. And the point that I really want to make here is that what we're looking at is a month of trading where price started the month and it started the year, and it started with a collapse. It started with a collapse, and it came out of this superb little pattern. And the little pattern that I'm referring to, let's just put a little bit more space between the candles. Okay, now if you look, my pointer is, yeah, there we are, right there. Now that's the start of the year, and the preceding candle to that little spinning top, okay, it went up to a high, and that high just popped above 134. Now, just in terms of standard support and resistance, 134 has popped price back in sort of relatively recent history during December twice before. So it's an area of significance, and those areas of significance are areas that I look at, and I just want to be aware of where they are, because the chances are there could be some form of a reaction there. So that was the green candle. It popped its little head just above 134. And then the following candle was a bearish candle, meaning that it went down. It's a red candle. But then it left behind a fairly long tail and a small body. Now, it's a bit of a cross between a doji. Now, a doji is where the open and close are almost exactly at the same spot. A spinner is where you end up with something that looks just a little bit like a child's spinning top that don't see too many in the UK these days, but sort of way back when I was a kid, it was the sort of thing that you sort of see very, very often. And it's an indecision candle. That's the main point. Now, the next candle is key. The next candle is key because what we've got is three candles together, and three candle formations can really tell the story. So price then popped up through the 400 level again, the 3400, and it popped up to just a few pips above that previous candle, and once again resistance came into play, and on down it went. Now, a bearish candle followed by an indecision candle followed by a candle which has gone up to a level where there has been prior resistance is a superb combination. Okay. Now then, that was the technical position. The fundamental position, well, I say the fundamental position, the perception in the markets of what the fundamentals actually were, was that the euro was completely and utterly doomed. And that's what kicked off the move from a market psychology point of view. And then, of course, we can see that we've got, followed then by that first bearish candle, a very, very big momentum candle. We know it's got stacks of momentum because it's a long candle. And the next one is not quite so long, and then we get a much smaller one. Right. Now, we get that superb little move on down, and anyone who studies harmonics will know that price then came down to a particularly important level. And it turned the corner just at the time when, certainly the previous day, any economic reporter, you get things on Bloomberg, you get sort of all manner of people saying that, well, you know, we're going to be seeing 122, well, 126 was the consensus. Then it was going to be 122, and of course, you know, there were the parity people who said that the euro is definitely going to go to parity. So one of the strongest indicators that I find that I really like to be aware of is ContraThink indicator. Now, I'm sorry to say, folks, that I can't actually give you a nice little bolt-on indicator that does it. But whenever commentators seem to be universally on one side of a market, look for the other side of it. So when you've got a market at an extreme with an extreme level of sentiment, look to trade the other side of the market. And that's exactly the trade that kicked off. So we ended up then with this massive move on up. Started off with the rumors of China and Japan buying Portuguese and Spanish bonds. Then it started to become a bit of a reality that it was actually going on. And not only them, but the ECB had been in there as well, buying. And there we are. Well, the rest is history, and we've seen this move on up. Now, what's going to happen next? Well, we are going to be talking about ATRs, but as you know, I'm an Elliott wave watcher, and what we're looking at right now is the development of a wave 5. Okay, we've got a wave 5, which is now underway. The bottom, of course, of the corrective wave 4, that occurred yesterday, and we've seen some really nice moves this morning so far, and it looks as if there's more to come. Got to put a bit of a health warning on it, of course, because we're now pushing up through the first band of resistance, and although I haven't got it on this chart, we've got other bands of resistance which are coming in strongly at 139 up to the 141 level. And that will be entirely consistent with the fifth wave. Anyway, enough of that, guys. What I want to just mention here is that there is an indicator on the bottom of this chart, and we're going to be talking about the ATR, the average true range. Now, I guess a good many of you guys actually use the ATR, and what I just want to present today are one or two uses of it, one or two alternative uses of it. So I suppose the first question is for me to answer would be, what is the average true range? Right. Well, quite simply, on this daily chart, we just take the low and take the high and take one number from the other, and we've got the range. We've got the range in a particular day. Now, of course, some days are going to be much wider range than others. Some are going to be really tiny ones. So it is averaged, and this particular one is averaged over the last 14 days. Now, depending upon what the market dynamics are, one can average this over a much longer period, and it's probably wise to do that over a somewhat longer period, maybe 55, up to 100 plus. But at the moment, I've just left this one on the standard 14-day setting. So if we were to just then do a look back, we could do the calculation ourselves, either by hand or on a spreadsheet. So we'd just be looking at the extremity of the high to the low, or the low to the high, doesn't really matter which way, for each day, going back 14 days, and then we just divide it by 14, and we would get this number, which produces, as you can see there, okay, a number which, forgetting the decimal point, that's 154 pips. So, The expectation is that on a typical day, the euro is going to move 154 pips. I mean, as we have seen, as we saw last Thursday, it's well capable of going over 200 pips. And of course, there are going to be a good many days when it just remains in a sort of a 50 pip range. So, how could a trader actually use this bit of information? Well, let's go down to a smaller time frame. And the way in which one can use this information is that where you get a runaway, as we've had this morning, kicked off, of course, by cable, but we've got a runaway market, and there tends to be a tremendous number of traders who will buy the highs and they will sell the lows. Now, that's all very well. That's all very well, and I really do not recommend that as a trading strategy. It's one which will probably put you into the poorhouse more quickly than any other. But a lot of traders do, and it seems to be ingrained in their psyche that that's what they want to do. But what you need to be extremely careful of following that type of strategy is how far has it moved already? Now, let's just look at this. We've got a couple of lines down here, and the low line, okay, is just showing us, well, we've got more or less where the market actually opened and more or less the low. The chain line over here is going to be 10 o'clock GMT, 5 o'clock EST, and that just shows where price actually started moving. So it started, and then it came all the way back to around about the 137 mark. So having just said that the euro is going to move in a typical day around about 150 odd pips, that suggests that the maximum that we should expect on this from 137 is going to be around about 138.50. Okay? Now, that further suggests that just maybe today, the euro has got more to go. And that may well be the case. But one thing I do want to throw in is that it's probably done now around about half of its ATR, around about 50%. As price goes further and further towards that ATR, the odds of it going for another 150 pips or 100 pips starts to disappear really quite rapidly. So the odds start to tail right off. I mean, clearly the very best place to get in is at the very, very start of a move. And there are umpteen strategies which really do help the trader get in at those early levels. Might be a harmonic pattern such as the ones that we were looking at yesterday. It may well be that we can pick out the trend with higher lows and we pick a significant higher low, which may well have one of those multi-point reversals that we've talked about before. So there are umpteen strategies to actually get in at the lows, but what the ATR will do, it will guard against the possibility of a runaway trend sucking us in to take the trade when just maybe we should be thinking that there just might not be enough ATR left in the day to make us money. And of course, another truism with the ATR is that the closer we get to the ATR for the day, the more likely trade is the snapback trade. It's the trade which might want to move back the other way because it's become a little bit stretched. And we'll look at the ATR stretch in just a moment. Right, so it's a get out of trouble free sort of card that you can play. And quite fortunately, pretty well every charting package has got the ATR on it. And it's not just the daily chart that you can use the ATR with. Here we are, got a 15-minute chart. Let me just knock off the... right, well, dry dessert. Well spotted. I was just about to knock off the volume, but let's just digress for a moment on volume. Now, conventionally for futures traders and stock traders, the volume that is reported is the actual volume, the sum total of the number of futures contracts which have been traded, or indeed the actual total number of shares which have been traded. Okay, so that's conventional volume. On Forex, that information, apart from the futures market, on spot is not actually recorded. Okay, but what there is an indication of the amount of tick activity which just might happen to be going through your particular broker or sort of group of brokers that sort of will pool their trades. Now, what is a tick? Well, a tick is one single price change, and on TradeStation it can be set so that you record tick volume or indeed true volume activity. If I put this at true volume activity, we won't see anything. So I've got it set on tick volume. And quite simply, all that means is that the more ticks there are, the more activity there is, the more people that there are buying and selling, the more price changes there are. So it is used as a proxy for real volume. Yeah, it's used as a proxy for real volume. In fact, it's quite interesting. You can compare, if you get a futures chart, say of British pound, and you then get a spot chart, and you put genuine sort of futures volume on the futures chart, and you put on the spot chart, you put the tick activity chart, which this volume is showing, then you will see a very, very, very great similarity. There will not be sort of massive changes. In fact, many people will say that tick volume is clearer and is more important than true volume, because one of the problems with true volume is that there could be, in the course of a day, when average trades going through, might be say 500,000 or something like that, and then all of a sudden there's a sort of a sort of a 50 million trade goes through, which is a little bit out of the ordinary, and that will show a massive amount of volume going through. Now, if that just happens to be on an uptick, then it'll look as if there are an awful lot of buyers in there. Well, there's probably only one. There's probably only one trade going off and one single buyer. Probably slightly unlikely it's going to be one single one, but you get the idea there. Anyway, right now, what I was going to do was to, yeah, indeed, Soros indeed. Right, let's just knock the volume off for a moment there. And what I'm going to bring in, we'll just bring an indicator in, pick up average true range, and what we'll have displaying right now is a squiggly line, bottom of the chart there, which is the average true range, not of the daily, but of the 15-minute right now. So what we can see here right now is that we've got an average true range, or a typical range, averaged over the last 14 bars of, look at it, 18 pips. 18 pips, average. Now, what we can actually see, and you can eyeball this straight away, that the current candle has actually moved considerably more than 18 pips, because there it was. It started down there at 37.40, and it's gone considerably above 18 pips. So, would you say that that one is overstretched or not? Well, yeah, it is. So, in relation to the average ATR, it's a bit stretched. And you know what we do with things like stochastics and the RSI and the MACD and all that whole raft of oscillators? Well, we use those as an overbought, oversold indicator. That's one of the ways that we can make use of those. But you can do just the same thing with the ATR. you can look at what is going on the current candle in relation to the average ATR, and you can immediately realize that, yeah, that particular 15-minute candle got a stack of momentum in it, but it's moved well above the average, well above the average. So the next question is, how could you actually use that information? How useful might it be? Well, where you've got a market which is overstretched, then it's going to be, first of all, a little sort of wake-up call to say, should I actually be buying an overbought market? And of course the answer is, you would have to be extremely careful in doing so. Now that's an understatement. In fact, I would say that you never ever want to do that. You never ever want to do it. But what you might consider doing is exactly the opposite. Now, by saying that, what you would also need is to have other factors in place, other things in place, which will actually tell you that just maybe a market is getting a little bit overstretched. And if it's overstretched, is it going to reverse? But let's just now move on to another little indicator, which a colleague of mine has developed, one of my members, one of my traders class members has developed, which is available to my members. And what we're looking at is this little indicator. Now, this is the daily chart of the euro. And let's just have a point of explanation. Down here at the bottom, we've got a histogram, okay? And the histogram is related to the ATR. So if we've got a big ATR, as we have right there on that red, right, on that very large, tall red histogram, that relates to a day when price really got carried away and it really stretched, hence the term, the ATR stretch, okay? Now, what actually happened after that? Well, the following day, price did go up, but then it resulted in a little bit of a correction. So what we can do now is to look back on some of these big red ones, and what we can actually see is that on this particular day, price shot up, it stretched, and you can see it stretched just by eyeballing some of the preceding candles, but it didn't hold the stretch. A bit like an elastic band, you stretch it, you stretch it, you stretch it, and eventually, your fingers it's going to slip through your fingers and it snaps back. And that gives rise to a trading strategy. There's another one. We've got another one just over here, where price became stretched. The following candle also stretched up, but then it bounced back. So could you then work out some form of a trading strategy based on the ATR stretch? Well, the answer is that, yeah, there's a possibility that you can. There's a possibility that you can. And what we'll be looking at is the possibility that when there is a trend that you can see established, avoid buying on the ATR stretch days when price is stretched well and truly above. But if price stretches on the downside, then that's probably quite a good time to look at going long. So there we are. That's on a daily chart. Let's just bring this now right the way down to a 5-minute chart. So there we go. That's price action this morning, and what we've actually seen then is quite a number of these which are stretched. Now, as you can see, there's a blue line running across here, and that blue line is the current ATR. Okay, that's the current ATR. So what we found is that price then has stretched itself well and truly, quite clearly on that very, very big candle, and it's saying do not buy at that time. Do not buy at that time. And let's go a stage further. What we've actually got over here on the left is built into TradeStation's radar screen. I'm actually not just doing a plug for TradeStation at the moment. I've actually used it for quite a few years, and I find it excellent. Very, very easy to use. And pretty flexible, so you can play around with all sorts of things. You can program things in, play around with the programming language, easy language, which is relatively easy, certainly in relation to a good many computer languages. It's very, very easy to use. But what we've actually got over here is something which actually calculates the stretch for us. Now, we've got here on the on a 5-minute chart what the ATR is, and then it works out a percentage of what the stretch is. And as you can see, looking down this list, we've got sort of 67%, the Australian dollar to 107%. So let's just click on that. Okay, and we can see that that preceding candle was well and truly stretched, and we can just look down this list and eyeball these for those that appear to be, that's the very self-same one, seem to have been moving on really quite dramatically. Now, at the moment, as we actually look at that, there is nothing that's gone sort of way over 100% with the last candle. But built into this is an alert. So if it were to go up to, say, 140%, okay, 140% of the ATR, then it triggers off an alert, and it will let the trader know. So you use it in two ways, Fernando. You use it to keep you out of the longs on a very, very stretched candle. But when you've got an established trend, you're looking for a possibility of a candle that could well be stretched in the opposite direction against the trend, okay, but still consistent with a higher high, higher low trend, and that's where you would get in. It's a different thing, Fernando. It's a different way of looking at a very, very similar thing. And the big difference here is that rather than just a straightforward RSI, then we're just looking at something which is based on the price action that we've seen and indeed experienced. So, yeah, in many ways it's going to tell you much the same sort of thing. You could, in fact, set up your alerts on an RSI to show the same sort of thing, to keep you out of trouble when it is indeed overbought. Right. Okay. So there we are. That's an ATR stretch strategy, or indeed indicator, that could be suggested. And yeah, that's what you're looking for, Boyke. That's absolutely what you're looking for. You're looking for something that could well snap. You can things, again, as you know, I'm an avid Fibonacci watcher and user. Link it up with a price popping up to a Fibonacci level against the dominant trend. you spot a stretch, and then down we go. Diligent? I believe that is the case. Yeah, I believe that Vicky Morden and Nina have got it all recorded. Right, now let me just throw in another little indicator. This particular one that you're looking at, you'll find this on a number of charting packages, and what we're looking at is this green line and the red line. Okay. Now, one of the problems, in fact, let's just make this a little more prominent size-wise. There we go. One of the problems that traders always have is, where do I enter and where do I put a stop? I mean, they're the two things that dominate our trading lives. And we usually put together some sort of pretty straightforward rules. But here's a little indicator that does the job for you. Now, let's just take this very, very last swing on the way up. So we're looking here, it's the Australian dollar, 240-minute chart. So each one of these is 4 hours. And so we've got a relatively sort of major trend in place. So this last part of the swing, it will change color, and when it changes color to green, it suggests that we ought to be long. And then eventually, if we just follow the green line up, and as you can see, it reaches these little levels, and one could then move a trailing stop just behind these levels. So it can be used as a trailing stop. Now, eventually, where that pointer is, it changes color. It changes to red. And as you can see, it changes from a bull position to a bear position. So it goes short at that point. Now, why am I showing you this? Well, I'm showing you it because it is based on the ATR. And one can change the indicator. You can alter the multiplication factor of the ATR. This one is currently set at 3 times the ATR. So it's calculating the ATR for that particular 4-hour candle, multiplying it by 3. So effectively, you've got a trading stop which is 3 ATRs behind price, wherever it sort of happens to be. Now you can change the number, you can change it to 2, you can change it to 1.5, etc., dependent upon the market. And there are people who use this and find it very, very useful. Now, one of the benefits of it is that it does tend to pick out the main trends. And one of the problems with it is that if you haven't got a trend, it'll do what pretty well every other RSI, stochastic, etc. will do. It'll chop you to pieces if you've got a fairly narrow range. But it's quite a useful little indicator that can just be plonked on a chart, and provided you've got a trending market, it will work absolutely brilliantly. But let me just bring in the health warning on it, and let's just go back to where that swing started, and let's just move back a little bit further left to where there is a hammer candle. Now, prior to that, the trend was well and truly established. It was established, we know that, because there was a succession of higher lows and higher highs. Yeah, I believe that's the case. Never used it, but I believe that's the case. And price then came back for a correction, and it came back to a level of prior price action. It left behind a hammer. So that hammer is the first heads up that just maybe the correction against the main trend has gone far enough. Right, let's just roll forward a few candles, well, 1, 2, 3, 4, 5, 6 candles to be precise. And 6 candles further on, we get a candle which tests the low of the hammer. And the low of the hammer remains intact. That is a strongly bullish sign. And then after that, price moves on up and it gets going. Now, traders who are aware of that pattern, that's a little mini 1, 2, 3 multi-point reversal, will be aware that they can actually get in really, really quickly, very, very early. And on the basis of this chart, prior to 99, with a relatively tight 60-odd pip stop. The early entry is usually the most difficult one to take, but it is also usually the most riskless entry to be taken. Now, having said that, we could have gone long using that multi-point reversal based on the hammer as a good entry. If we were to wait for this little swing trend price to actually kick off and change, we're not going to be getting in much before about 99.90. And it's suggesting that we're going to have a stop right the way down here at about 98.60. So a subtle difference there on the amount of risk that we'd be carrying. Consequently, greater risk that you're carrying, the trader then is going to have considerably less of a position size to actually cope with it. Right, so there we are, guys. That's a couple of uses of the ATR. How you can use it as a quick indicator of not buying an overbought or selling an oversold market, where price is getting towards maybe around about sort of, if it's done more than about 60 to 75% of the ATR for the day, then take very great care, folks. Very, very great care. Yeah, good point, traders. Yeah. If it fails, I mean, a hammer is probably one of the most reliable candles. In fact, there are quite a few on this chart. Right down there on the 12th of January, there was a mother and a father of a hammer. Long, long, long tail, okay? Much, much smaller body. Doesn't really matter what color the body is. I mean, ideally it's going to be green, but the key thing is the length of the tail. The longer the tail, the better. And any hammer, okay, which the low of it is tested and the low holds, all right, by subsequent candles, that is importantly bullish, all right? If, on the other hand, a hammer has its tail actually taken out with price going below it, then exactly the opposite is the case. Then that is very, very, very bearish indeed. And that's where, you can make use of failed hammers. Failed patterns are brilliant because so many traders will be expecting exactly the opposite to be the case. Now, we've got one or two other hammers here. We've got quite a few other long tails that you can see at lows. This one just over here on the 17th was, well, just prior to the 17th, we've got on the 16th, what there is a long tail. Not a perfect hammer because it hasn't got a particularly small body. In fact, the length of the body and the length of the tail are more or less equal, but it's got the characteristics of the long tail. What does a long tail mean? Well, quite simply, the psychology of the market is that there were lots of sellers in there, but they've been completely overwhelmed by the buyers. So, it's telling us there's support there. And then subsequently, as you can see on the 17th, we've got the next most important candle, which is an engulfing. It attempted to break the lower tail of the hammer, didn't manage it. Those buyers came back in, pushed price all the way back up, and what did it do? Well, it completely engulfed the preceding candle, and it also engulfed the one before that, and the one before that, and the one before that. So, very, very, very strongly bullish candle. As we can see, that resulted in a very, very useful up move that went through, best part of about 130 odd tradable pips. Yeah, time and time again. So what we've seen on this Australian dollar, that really for the last few weeks, we've got a whole series of these long tail lows. Okay, nothing. Boyke is exactly the same thing. I just call them tails. Some people call them shadows. I think Steve Nisson calls them shadows. Some call them a wick. I call them tails. Exactly the same thing. Okay. So, quite simply, what this has really been showing is that a base has been building, and it's been building for the last few weeks. And eventually, of course, we've seen the breakout. The trader's secret, though. Oh, sorry, he says shadow. Yeah, okay. So the trader's secret is to get in just when nobody else is getting in. Is to get in where you're seeing price come right down to the bottom end of the trading range, and that is the area where there is likely to be most support. But it's also the area that the majority of traders just don't go long. They're waiting for the breakouts. Where I came in right at the beginning of this presentation, then what they want to do, they want to buy the upside breakouts. And it's all wrong. They should be buying the tests of the lows, and they should be selling the tests of the highs. Right, okay guys, there we go. Right, KB, you can find this indicator. I've actually modified it for my own use, so it's one that I can make available to my Traders Class members, but I think you can get it on other ones. You will find, I think you'll probably find it's called Super Trend elsewhere, but you'd really do want to make a few modifications to it. I've got alerts set up on it and all that sort of stuff. So the basic one is pretty basic. It's pretty basic. Right, okay guys, that's we're getting pretty close to time right now. Yeah, good point. Absolutely good point. Let's just pop on a parabolic SAR and you can see the difference. Where are we? P, parabolic SAR. Here we go. Right. Now, let's just look at the long swing up here over on the left. The one thing that the parabolic SAR does that this super trend indicator, this swing trend indicator does not do, parabolic SAR gets closer and closer and closer and closer to price action. Okay? Now that's a good thing, certainly for the likes of scalp traders who want to maximize every last pip. But what it does do, it knocks you out of corrections on trends. So you've got to sort of just really take your choices as to what you might want to use. Now, you can see there that the little PSAR stars were getting closer and closer and closer and closer to price action. And it will enable you to get the best out of a surging trend, but it won't keep you in the big trend. It'll sort of chop you in, it'll chop you out. You can, of course, change the settings on it. All right? You can change the settings. Well, you can change the settings on both to sort of more or less emulate each other. But they're just a slightly different feature, whereas the swing trend indicator just shows a constant ATR level away from the current price. So yeah, we've got so many indicators that we could actually use, and I guess that in this world where we can choose from hundreds of different indicators and sort of little mechanisms that we can use, it's a question of finding whatever we're most comfortable with ourselves. And for me, it's really getting rid of pretty well everything and just looking at price action and coming down to identifying areas of support resistance. I like to look at Elliott waves. I like to use Fibonacci and harmonics particularly. And I want to be buying when nobody else is buying. I want to be selling when nobody else is wanting to sell. And then hopefully they're going to see the light and they'll then power the market in the direction that I've already got into. That's perfection, of course. We all get it wrong from time to time, and all we can do is to put as many odds in our favor as possible. Okay, guys, that's my presentation done for today. Have a really good February. It's the first of the month, and I guess that volatility will continue. Keep a close eye on what is going on in Europe. Particularly look at what the Irish are going to be getting up to. There's a key date on the 11th of February, which is one of those important sort of meetings to clarify what is going on with the bailout fund. Also look closely at the elections and the result of the Irish election, because if there's going to be some form of big problem in Europe, I reckon that Ireland will be the catalyst for it. So plenty of volatility to come, guys, and many thanks for being here today. See you next month.